Markets go up, then suddenly crash, and you feel confused like what just happened. You check your phone and everything is red. It feels stressful, like you're always late. Then suddenly the market goes up again, and now you're even more confused. But behind all this, there's a hidden system called macroeconomics. This system controls money, markets, and decisions, yet most people ignore it. First, GDP shows how an economy grows, and when growth is strong, markets feel confident. Then comes inflation, where prices rise and your money slowly loses value. And when inflation gets too high, people panic. But when prices fall, things feel easier. That's deflation. Understanding these cycles helps you see the bigger picture. Now look at the labor market. When people have jobs, they spend more, and more spending drives growth, pushing markets up. Banks also play a big role. They create money through credit, and more credit means more liquidity, which drives markets higher. But interest rates change everything. When rates go up, money becomes expensive, and markets don't like that. So they fall. Governments spend money through fiscal policy, while central banks control interest rates through monetary policy. Even bond markets give signals like the yield curve. Money doesn't stay in one place, it flows across the world, moving where opportunity exists and leaving where risk increases. When you understand all this, you stop reacting emotionally, you ignore short-term noise and focus on the bigger trend, because macro is like the wind that pushes your investments. Master the system, not the headlines. That's how real investors win.